Imagine two investors. Wendy refuses to buy when the market feels expensive. She's disciplined, she waits for a pullback, and she tells herself she'll jump in the moment there's a real correction. Then there's Bridget. Bridget invests whenever she has money, no matter what. And to make it worse, she has terrible luck. She somehow always seems to buy right when the market hits a new all-time high. Now, common sense says Wendy should crush Bridget over time, right? She's being careful. Bridget is basically buying at the worst possible moments. But here's the thing. That's not what actually happens. And the data on this might completely flip how you think about investing. In this video, we're breaking down why investing at all-time highs has historically outperformed waiting for a dip, what the research actually shows, and the psychology that keeps so many people stuck on the sidelines waiting for a moment that may never come the way they expect. Quick disclaimer first. This is not financial advice. I just want to walk you through the data so you can think about your own strategy more clearly. Welcome to Aldric Finance, where we explain investing concepts in a simple way. Let's be honest, waiting for a dip sounds like the responsible thing to do. Buy low, right? It's basically the first rule of investing everyone hears. So, Wendy's approach feels logical on the surface. She's not being reckless, she's being patient. But here's what most people miss. Waiting for a dip is still a form of market timing. You're essentially betting that prices will be lower in the future than they are right now. And that bet doesn't need a crash to fail. It only needs the market to keep climbing longer than you expected. That's exactly where most cautious investors get stuck. Not because they were wrong about a crash happening eventually, but because they underestimated just how long a bull market can run before that dip ever shows up. So what does the research actually say? Analysts looking at S&P 500 returns going back several decades have compared a few different strategies side by side. One strategy waits for a meaningful pullback, say 10% down from a recent high, before investing. Another strategy does the opposite. It invests immediately every single time the market hits a brand new all-time high. And a third strategy just invests on random days. No strategy at all. Historically, investing right at all-time highs has produced stronger average returns than waiting for a pullback. It even outperformed investing on completely random days. And I know that sounds backwards. Why would buying at the most expensive point possible be patiently waiting for a discount? Here's where it gets interesting. All-time highs don't usually happen in isolation. They tend to cluster during strong bull markets, periods of economic expansion, rising earnings, and heavy investment flowing into stocks. Healthy markets don't typically hit one new high and immediately collapse. They often hit a string of new highs in a row, one after another. So while Wendy is sitting on the sidelines in cash, waiting for her 10% pullback, the market often just keeps climbing. Sometimes that dip she's hoping for never even shows up. Other times it does show up, but only after prices have already climbed so much higher that even the dip is above where she could have bought months earlier. This is the hidden cost of waiting. It doesn't feel risky sitting in cash. It actually feels safe. But waiting has a real price tag, and that price is opportunity cost. Every month Wendy waits, she's missing out on gains, missing out on compounding, and missing out on dividends that could have been reinvesting the whole time. Now let's talk about Bridget, the one with supposedly terrible timing. Yes, if she happens to invest right before a major crash, that specific chunk of money takes a real hit in the short term. Nobody's denying that. But Bridget doesn't invest just once and disappear. She keeps investing consistently year after year through crashes, through recoveries, through new bull runs. That means her early investments have decades to recover and grow. A market peak today can genuinely look like a small bump on the chart 10 or 20 years from now. Think of it like planting a tree. Does it really matter whether you planted it on the sunniest day of the year or the cloudiest one? Not really. What actually matters is that you planted it and then gave it years to grow. There's another important piece of research worth mentioning here, this time looking at the cost of missing the market's best days rather than timing entries. Studies analyzing decades of S&P 500 data have found that investors who stayed fully invested dramatically outperformed those who missed just a handful of the market's best trading days. Missing only around 10 of the best days over a 20-year stretch has been shown to cut total returns by more than half in some analyses. And here's the key detail. Many of those best days tend to happen during volatile periods, right after sharp drops, exactly when fear is at its highest and people are most tempted to stay in cash, which means investors waiting for clarity before jumping back in often end up missing the recovery entirely. Let's go back to Wendy and Bridget with actual numbers in mind. Say they both have $500 to invest every single month for 10 years. Wendy holds her cash back whenever the market feels expensive, waiting for that 10% pullback before deploying it. Some months, she waits 2, 3, sometimes 6 months in a row because the pullback just isn't happening. Bridget, meanwhile, invests her $500 the moment she gets it, every single month, no matter what the market is doing that day. By year 10, Bridget has been fully invested this entire time, capturing every recovery, every dividend, every stretch of growth along the way. Wendy, despite her disciplined patience, has large chunks of cash sitting idle for months at a time, missing out on periods of growth simply because her specific pullback trigger hadn't been hit yet. In most historical periods, Bridget's steady, unemotional approach ends up ahead, not because she's smarter, but because she's never sitting on the sidelines waiting for permission to invest. This is really where most investors struggle, and it's worth talking about honestly. If you've ever looked at the market and thought, this feels too high right now, you're not alone. That feeling is deeply tied to something called loss aversion. We feel the pain of a loss far more intensely than we feel the pleasure of an equivalent gain. So when the market is sitting at record highs, our brains instinctively scream danger, even though historically, all-time highs are very often followed by more all-time highs. Markets actually spend a surprisingly large amount of time near record levels. Trying to wait for a better price often just means missing the days that matter most. Now, to be fair, this isn't a black and white decision. Investing at all-time highs doesn't mean you should ignore risk management completely, and dollar cost averaging into the market consistently, regardless of highs or lows, isn't the same as blindly gambling. There's also something worth noting. A lot of this research is based heavily on the U.S. stock market specifically. Other markets around the world haven't always behaved the same way, so this pattern isn't a guaranteed law of investing everywhere. On the other hand, the core lesson still holds up pretty well across the data. Waiting endlessly for the perfect entry point tends to cost more than it saves, and consistency tends to beat perfect timing more often than our instincts would suggest. So here's the real takeaway from all of this. It's not that buying at all-time highs is some secret trick to beat the market. It's that time in the market has historically mattered more than timing the market. Consistency beats waiting for perfection. If you're sitting in cash right now because the market feels too high, it might be worth asking yourself honestly, are you being strategic, or are you just letting fear dress itself up as patience? If you found this helpful, go ahead and hit the like button and consider subscribing if you want more videos like this. Let me know in the comments, are you more like Wendy or more like Bridget? And if you like this one, I think you'll really enjoy the next video too. Thanks for watching, and I'll see you very soon. Bye.